Hello, this is the capstone project of the cognitive science at Georgia Institute of Technology. Today, what I'm going to present is the research paper named The Psychological Science of Finance and Exploration of the Impact of Emotions and Cognitive Bias on Investment Outcomes. So let's start with the introduction. We will begin by talking about the impact of emotions and cognitive biases on investment outcomes. And then we will go through in-depth analysis of literature and emerging trends in behavior finance and links to cognitive science. And then we will talk about why individuals behave in certain ways and how to mitigate the effects of emotion and cognitive biases in our investment decisions. And I believe this is closely linked with cognitive biases and cognitive science and how its applications can be applied to investment decisions and how investment bankings and also individual investors will behave in certain ways and be trapped into behavior biases when it comes to financial investment decisions. Now let's start with the literature review. What is behavior science? It is an interdisciplinary field examining psychological and emotional aspects affecting financial decision makings. The impact of cognitive sciences or cognitive biases on investment decisions will be covering a wide range of topics, including topics like overconfidence, availability heuristic biases, anchoring biases, and mental accounting. Those biases will be influenced and it will be influencing people's behavior when it comes to investment decisions. And we will see how these insights into the factors influencing those investment behavior and decision making. So let's delve a bit further into those investment biases. Overconfidence, it is a tendency to overestimate abilities and accuracy of beliefs. Availability heuristics, it is an overestimation of likelihood of positive outcomes. So for instance, when stocks have a bull markets, then people might think the stock prices will keep going, and that's why they keep holding the stocks without thinking about the likelihood that the stocks will go bust and we should sell the stocks. Anchoring biases, it is the reliance on initial information when making judgments without factoring other external environmental factors. The third final one is the mental accounting. It is categorizing and evaluating financial information based on biases. Now, how emotions in investment outcomes will affect our decision makings. Fears, anxiety, and greed can all influence our investment decisions. Fear and anxiety can lead to selling assets at a loss, and greed can drive investors to acquire overpriced assets, all of which will be some irrational behaviors when it comes to financial decisions. So how those impact of cognitive biases and emotions will impact on our investment outcomes. So all those investment biases will lead to imprudent investment decisions and poor judgments based on incomplete or inaccurate data and your mental thinking and judgments, and those will lead to poor judgment in general. Let's talk about a financial data and financial crisis, and I give a concrete example about how investment biases will lead to bad investment decisions. This is a case study of behavior finance in practice. It is about the proliferation of mortgage-backed securities based on assumption of continually rising house prices. There are some certain misbehaviors or irrational behaviors, such as herd behaviors among investors, and those impact of external information and recommendations on investor behaviors. Emotions such as fear and greed contributing to this suboptimal investment decision, leading to the catastrophic 2008 financial crisis in general. Next, this paper also explores further in terms of data analysis. We will conduct a thematical analysis approach to identify and code recurring themes and patterns, with the hope of this category used to develop a narrative of those findings and figured out the impact of overconfidence, herd behavior, availability heuristics, all those investment biases, and how those emotions link to cognitive science and how those behaviors will misbehave and lead to the misjudgment on investment decisions during the financial crisis. Based on our analysis of this literature on the 2008 financial crisis, we have certain findings. First, as many investors and financial institutions display overconfidence, in their ability to assess risk and predict future market movements. Next is the financial crisis revealed a strong tendency for investors to engage in herd behaviors, blindly following the actions of others without critically evaluating the underlying fundamentals of the investments, especially during dot-com bubbles and also housing bubbles during the financial crisis. People do not have a clear mind about when to stop investing and exit the markets. The third thing is the availability heuristics play a significant role in shaping investors' perceptions of the likelihood of positive outcomes in the housing markets. Then is the external information and recommendation had a significant impact on investor behaviors during the crisis, such as fear and greed. Last but not the least is the emotions such as fear and greed that play a crucial role in investors' decision makings. This interplay between emotion and cognitive biases led to a series of suboptimal investment decisions in general that ultimately contribute to the severity of this crisis. And those crises demonstrate the complex interplay between cognitive bias, emotions, and investor decisions during the 2008 financial crisis, which leads us to think behavior finance and cognitive science, how those science and emerging science will be playing an important role in contributing those factors and explaining those factors why people will misbehave, unlike a rational investment agents in the rational and classical economics, because they highlight the importance of incorporating those economics insights and also behavior finance insights into the understanding of these financial markets and how developing those strategies can mitigate the risk of similar events in the futures. Especially during COVID lockdown crisis these years, it seems that we are going back to the 2008 financial crisis, but whether some of those experiences can be learned from 2008 financial crisis and prevent us from repeating the same tragedy again, this will be something that was much more important and essential and worth discussion for us. So let's discuss some emerging trends in behavior finance. So behavior finance, it examines the psychological and emotional aspects affecting financial decision makings. It has gained significant prominence as it provides valuable insights into the role and cognitive biases in investment outcomes. So those will be critical, and it closely linked to investment, finance, and also cognitive science, and how cognitive science can explain certain factors. How brain science works will have an explanation on how people misbehave when it comes to financial decisions. And those effects of mental misbehaviors can ultimately lead to poor judgments in finance in general. In conclusion, this paper has examined all those impacts of emotions and cognitive biases on investment outcomes through an in-depth analysis of literature and also emerging trends in the field of behavior finance. In conclusion, it also summarized the psychological factors significantly influence financial decision makings. We also study the psychological aspects of finance, offering valuable insights into why individuals may behave in certain ways and how to mitigate those effects of emotions and cognitive biases in investment decisions. Then it is also critical and crucial for individuals to be cognizant of and activities address these biases. Then finally, financial professionals should also integrate this understanding into their investment strategies by understanding the cognitive science, brain science in general, and how people's behavior might have an impact on their own investment decisions, and how we can come up with some corresponding strategies in order to cope with this situation. Thank you very much, and this will be the summary of my research paper. In general, it is quite comprehensive paper, and it summarizes all those aspects of cognitive science and links between cognitive science and investment behaviors. Thank you very much.